are going to do some different slides. So with that, I'm going to jump right in. So I always put this slide up. I don't expect anybody to read it while it's on the screen, but the idea is that if you are
so you have to read it.
Yeah, sure. Yeah, you can read it quickly, maybe. But the idea is that if you are going to invest, those same lawyers have written lots of disclaimers in the package you have in front of you. So there's a lot more to read there, and we will encourage everybody to read all the disclaimers before making an investment decision. And so just to do a quick intro to Cranston Capital, we're an exempt market dealer and we focus on Canadian private real estate. We're regulated EMD, registered in 5 provinces. We focus on real estate, mostly residential development. We'll also look at income producing real estate and land for future development. We have a 15-year track record. We have 27 active projects today, and by the end of 2026, it'll be 2,300 homes total that we'll have built. And we always put investors first. We try to put investor hurdles, priority hurdles in every deal that we do. And we make sure that the developer has significant capital in every deal as well. And so just a little more on our track record, we have $3 billion of active development pipeline. You can see the map on the screen, mostly GTA based, 300 million in equity, 27 active projects, and the number I said before, 2,300 homes by the end of 2026. And so just going to get into a little bit about what's going on in the market right now. Obviously, you see lots of news and headlines and things are happening. The biggest thing that is driving that is the condo completions. So currently we have a glut of new supply. 30,000 was a record number of condo completions in 2025. These are condos that were sold in 2019, 2020, 21, 22. So really at high prices, and now they're finally coming to market and they're finding out that the market prices are a lot less than what the pre-construction prices were. And so the other side of that is that they're being absorbed. So 81,000 leases were signed in 2025. So while there is a lot of inventory on the market, the people who are renting their units out are getting tenants. But that leads to the price correction, which we see in the condo space I mentioned before. 2022 prices were the peak, and since then they've dropped about 18%. We're going to talk a little bit about the HST rebate, which is 13%. So, you know, if the prices dropped 18, but your cost went down 13, it's not that bad at the end of the day. But the real story that we're focused on is the future housing supply. And we can see that Q1 2026 sales were 94% below the 10-year average. So literally the condo market has just come to a halt, and no new pre-construction means no new launches, which eventually will mean no new supply. So that leads us right into this future supply gap. So 2026 is a little less. 25 was the record of 30,000. 26 is still pretty strong with 22,000. So you're going to hear the news in 26 about rents dropping, values dropping. That is because it's 22,000 units that are completing that were built at much higher prices. But then you start to look forward a little bit and you can see that 27 is a big drop. And you can know this because it takes 3 or 4 years, maybe 5 years to build one of these buildings. So 27 numbers are what started in 23, maybe 24, probably not 24, probably 22 and 23. 2028, it gets even lower. And that's because we didn't really start very much in 2023, 2024. And Urban Nation says by 2029, we will have 0 new condo completions in the market. So this is the supply gap that we're talking about. It's a 70% decline in condo completions by 2029. Yet the CMHC is telling us that we need to build 130,000 new homes a year in Ontario by 2035 to restore the affordability that we had only 10 years ago. So we got to figure something out. We're not building it with condos. Another big thing about the condos are that we didn't build the right unit types. And you can see here, this is the number of 3-bedroom dwellings between 2016 and 2021. And Toronto is the worst. Last in 3+ bedrooms from the other 14 largest Ontario census divisions. And what does that do? It means that families are forced to leave the city. They move out of the city into the suburbs, and that's where the that's where you see a lot of townhouse demand right now. And so we do see some tailwinds. Obviously the weak housing starts is a big one. 0 new condo launches, the first time in 30 years that we had 0 new condo launches in a quarter. But the big benefit to that is because nobody's starting construction, the construction costs are coming down. So 34% all-in development cost reduction. That's since 2022's peak. And I said before, the family housing was a real problem. So this stat was really interesting to me, that 3.8% of all those high rises, I just showed you 30,000 this year, 22,000 next year, less than 4% are 3 bedrooms. So I think we had an issue in Toronto where developers were building for investors. Investors saw this demographic of millennials, young people who wanted to be downtown. And that was true when they were in their 20s. And that was when it was 2015 to 2020. But in 2030, they're not in their 20s anymore. That cohort, that big population base that drove a lot of the condo development, is getting older and wants family-oriented housing, and we just don't have it. So the big change that's driving townhouse and low-rise construction is the HST rebate. So 130K reduction on the HST on $1 million home. And the government's also announced DC relief. So development charges have always been a big cost item for developers. And the province and the federal government came out with an $8 billion plan to supplement the municipalities so that they could lower the development charges by up to 50%. So far, we've seen some municipalities jump on that. Vaughan went to 0. Mississauga, I think, did a big drop. The city of Toronto has not announced what they're doing yet, but we are expecting that they are going to drop the, maybe not 50, but 40%, something along those lines. But townhomes are where the buyers are. So this is some fresh data, Q1 2026. Look at the sales in 2020 and Q1 2026. There were a total of 1,400 units sold in 2026 in Q1, and 80% are townhouses. Townhouses represent 63% of what's being launched. And on the pricing, townhouses are, not materially higher than condos, but you get materially more living space. But the big note for me on this slide was that you can see where the townhouses are: Markham, Mississauga, Brampton, and Milton. What I said before, if you're in the city and you're in one of these condos and you're having a family and you want to move up, you got to go to Milton. So I think this idea of building townhomes in Toronto is a great idea, and Profile seems to be the only ones doing it in Scarborough. So that brings us to the project. And so it's this project has been going for a couple of years now. It was an $11 million raise that we started about 1.5 years ago. We raised $7.5 million. We bought the land. We put in the zoning application, and we stopped the capital raise because they didn't need the cash at that point. We knew once they got zoning approval that we would need to go finish and raise the other $3.5 million. So the idea was that it's much better for investors to come in when it's zoned, which it is. It's approved for, recommended for zoning approval right now. It's going to be on City Council on Thursday, so very timely. So it will be zoned this week, and there's 2.5 years left. So it's a very compelling timeline. You can come in on a de-risk project and have a short time horizon and still generate a 20 IRR. The location is Bellamy Road South and Kingston Road. It's 1.875 acres. It is condo townhouses. They're stacked down, so there's a common element aspect to it. 146,000 square feet, 110 units. And as I said, on May 11th, they recommended zoning approval, which is really the big step. And now it just needs to get stamped by council on Thursday. So another interesting point about this is that we're able now, without the HST, to get the prices to be very similar to the resale market. So these are 1,200 square feet average, and the average price is under 800,000 and 660 per square foot. So, if you look, we're going to show you a slide. We sold a townhouse project in 2022 in Scarborough with Profile, and we got over 1,000 a foot. So 660 is a big reduction in price per foot, which basically means for that 800 grand, they're getting a decent sized space. And so you can see the site there, and kind of here you can see where it is. It's next to another townhouse complex, and there's another view of it from Kingston Road. So you just get a good idea of where it is. And so there it is on the map, and we've got good access to transit. There is obviously on Kingston Road, there's TTC bus service that goes to the subway. But there's also Eglinton GO, which is a 10-minute walk, 10-15-minute walk from the site. Scarborough GO and Kennedy GO aren't far. There's some great schools in the area, Scarborough Golf Club, and some great retail. But I think the biggest draw is that you're really right by the lake. And you can see on the map, there's that Sylvan Park. When we first did this deal, I went and took my kids and we went down to the park on the lake, and it was a really beautiful area. I really didn't have any idea how beautiful this part of the city was. I'm going to show you I thought it was the slide, but it'll be in 2 slides. So here's the GO train. So it's 1.1 kilometers from the site. Basically, you just walk down Bellamy. It's about a 15-minute walk. And then that's direct service to Union. And then the other thing that's happening is the LRT. So the Crosstown LRT is open now. The City of Toronto announced that they're going to do an extension, and they're going to bring the Crosstown up to the U of T campus in Scarborough. And so you can see at the bottom of the map is the Eglinton GO, and we're walking distance to that. And then even the station next to that, Mason, is about a 12-minute walk from the site. So 2 subway stations or LRT stations coming. I don't know when they're coming. We say future, but if someone buys here, they can expect that they'll have better transit coming soon. And so this is what I was talking about before. So this is Scarborough Bluffs. When I look at this picture, I don't think of Toronto or Lake Ontario. It's not what you think of when you hear those words, but this is the Bluffs, and it's beautiful. It's really underused. And I think it's a great place to live because you have great access to downtown, and you've got this great outdoor space really close by. So when we look at the development, it's a little bit of a misnomer when we say there's 133,000 square feet that's saleable, because we don't include the basements. And 18,000 square foot basement actually is a real impact, because we're going to have 4-bedroom units because the basements enable a 4th bedroom. So the 110 units, so the average square foot is 1212. That doesn't include the basements. So when you include the basements, the average square foot is going to be a little bit higher. The average price, $799, $660 per square foot. One thing that when we first launched this that we had a challenge with was parking. And so when we first launched this, we were showing, maybe 50% parking. And that was the comment that most investors said to me: who's going to buy a townhouse without a parking spot? And so one of the things that they did through the zoning application was they worked and worked and worked to get more parking. And now for 110 units, they have 108 parking spots. So pretty good at that. And we're saying they're 40,000 a spot. That's a real deal. In the city, those parking spots are 80, 90,000. So this is Scarborough. I don't know if you can get 80, 90,000 for a spot, but I think there's some room to get a little bit more. And there you can kind of see the layout. It's in 3 buildings on the site with the surface parking there. And so when we look at the unit mix, 2% are 2 bedrooms, but still a 1,200 square foot 2-bedroom, that's not a condo. 607 per square foot, that's a pretty good price for a 2-bedroom. But 55% are 3 bedrooms. That's the family-oriented angle that we're going for, 1,296 square feet. And then 43% of these are 4 bedrooms. And 820,000 for a 4-bedroom in the city of Toronto. I don't think you could find that anywhere else. So when we look at the unit types, it's stacked town. So you have units on top of each other, and the top units are the 3-bedroom units. So you can see the 1,296 square feet. They're going to have the rooftop terraces, and they'll have a common hallway down the middle. They'll enter at one end of the building. They'll have a common hallway and enter their units from the hallway. The ground floor units are the 4 bedrooms, and they'll have walk-up access to their units. Maybe a little space outside, like a little yard space in the front, and they'll have the basements. So those are almost 1,500 square feet. And so here's the image again, but now I'll show you what it looks like with the rendering on top. So You can see you drive in from Bellamy, and both buildings are on either side of you, and you have your parking there and then parking at the end for the last building. So just to give you an idea, I say it's anchored to resale. And so when we look at the resale market, these are all transactions that happened. Well, one is December 25, but most of them are from earlier this year. And you can see some are detached and semi, and they're still in that kind of same price range. So the idea here is that the housing stock is 40 to 50 years old. So your choice is you can get a 40-year-old townhouse for $735,000, or you can get a brand new townhouse for $799,000. So we think it's pretty compelling. We think that people are going to want to move up into the new units. Just new everything is the energy efficiency, technology. There's just so much appliances. There's so much better stuff in the building today. Now, obviously, some of these houses on the resale could have been renovated heavily, but you would expect that they would get a little bit more money if they were renovated. So we're right in that price range, and we think it's going to be compelling for people who live in the area, and then also for move-up buyers who are, like I said before, in condos, wanting to start a family and wanting to move to a family-oriented space. And so this is what I was talking about. We've had one launch since 2022 in Scarborough, and that was the Inspire Modern Towns. Huntingdale was our project, and we were 1,000 a foot when we launched that, and did very well on the sales. And then you can see the rest of the stuff is kind of 600 to 800. So our pricing is right in there. It's hard to really compare 2026 launch prices to 2021 launch prices. Obviously, the market's very different. So it is hard to kind of peg where you are in the market when no one sold anything. But I think the resale is the best thing that we're anchored to. And so just to give you a sense of the timeline, like I said, we closed on the land in Q1 2025. In Q2, just in May 11th, we got our recommended approval, and we're going to get the stamp on Thursday that it's going to be approved. And we plan to launch sales later this year. Obviously, that's going to be market dependent, and we think the HST rebate is going to be a big driver. But the market is starting to pick up. We just showed you the 1,000 townhouse sales already. And that would let us begin construction in Q2 2027, so that we can complete construction by the end of 2028 and get to our profit sharing by the end of 2028. So just to give you a little background on Profile, and Mike Petrovsky is here from Profile. He's the developer. They have their team has over 40 years combined experience in development. They focus on the missing middle. Really, townhouses has been, and stacked towns has been their focus. They're vertically integrated, so they have their own construction team, which makes the projects work a lot smoother. And because we have 4 projects with them, we're able to kind of move the construction team from project to project and keep things moving along. And it's a diverse management team. They cover kind of all areas between Mike's experience on the development side and sales and marketing, and then Constantine, who's not here, is the construction side. So it's a good team and good management diversity. And there we are. Mike here is the managing partner. He's a co-founder, and he started as a custom home builder, and really been in the real estate business his whole life. Not only here in Toronto, but also has a development business in Europe. And Constantine is the construction manager. He's done a lot of work in the townhouse space, worked for some big developers like Freed and Daniels and Rockport. And he joined Mike when they started Profile, I guess, almost 10 years ago now. And the projects that we've been involved with them have been great. I mentioned Huntingdale Town. So this was 81 unit freehold project. The construction is now complete. If you get a chance to go check these out, they did a great job of building these. January 2026, investors got all of the capital back plus some of the profit. We have some units that we're still working through sales because we had some defaults from the buyers. But we are projecting a total return of 138% for investors. When they originally went into the deal, they were told it would be 100%. So we're well ahead of our projections still, even with what's happened on the defaults. Textbook Towns is a very interesting story. This is across from U of T Scarborough. We plan to build this as kind of investor product. It was going to be student housing. We designed all of the units where there's no master bedroom. Every bedroom has a ensuite. The common areas are very small, like not a big living room, because we expect students to rent by the bed. And I guess it was a year and a half ago, we thought we would try to launch sales, and that's kind of when the whole market was dead. And so we've been kind of figuring out what can we do here. And what was really interesting was earlier this year, we started talking to lenders about lending us money as a purpose-built rental. So can we build the townhouses as a rental? And this makes sense because this is student housing. And so when it's finished, there will be student housing operators who will be happy to buy this. There'll be a lot of investors who would want to buy a finished 51 unit student townhouse across from U of T Scarborough. But what was very interesting was that there's nothing in the design. We didn't have to change anything on the design. We didn't have to change anything on the layouts. We keeping it the exact same as if we were selling it or renting it. And so when you do that with the condo tower, when you convert a condo tower to PBR, you usually have to redo your layouts, change some of the structure of the building, change the amenity space. There's a lot of changes when you're changing a condo tower to a rental, but on a townhouse, there are no changes. So one of the things that's interesting is that if the market comes back while we're under construction, we can get our cherry on and go back to selling. So just because we're getting the financing on textbook doesn't mean that we're committing to building it we're committing to building it, but not keeping it as a rental. So to me, this was a great move by Profile in this market to be able to get the projects moving, even if they're not selling. Now, I bring that up because we're expecting that Cliffcrest will sell, no problem with this HST rebate. But if it does have some challenges selling, we can still build it as a rental and then sell it later. And that's the next project is Fairview, and that's what we're actually debating right now. The conversation we had with Mike today was really there's no downside to starting construction as a PBR, so might as well. And he could even sell at the same time that we're starting construction. So Fairview is another stacked town project near Fairview Mall. It's zoned and planning to start construction this year, whether it's for sale or purpose-built rental. And so I always bring up the directors of the GP is Anthony Heller and myself. Anthony is the founder and president of Plaza Corp. He's got 40 years of real estate development experience. He's built over 13,000 units. You know, I'm talking about 2,300. He's talking about 13,000. So very experienced developer. The idea here is that we are the general partner, so we control the limited partnership and we hire the developer under a developer management agreement. We have clauses in the development management agreement where they have to come to us for major decisions. So we have corporate governance in place where we make sure the developer is not, going and doing things on their own without some guidance from us. And then there's also this possibility that if the developer trips up, we could step in and finish the project. So I always bring that up because Anthony had to do that on a partnership that he had about 10 years ago, where the developer got into all kinds of trouble and he had to step in and finish a couple of projects that they were joint ventures on. And he did that successfully and rescued investors and did great. So we know he's capable of doing it. We don't think that we're going to have to do it on any of the projects that we're involved in, but it's always there in the background. And so the deal structure, one of the things everybody always asks, what about the skin in the game? And so the developer has 20% of the equity. They put up 2.2 million. They also are putting up all the bank guarantees and dealing with the warranties. And basically they're doing all of the work as well. And so the way the structure works is it's a limited partnership. Investors invest in the LP. There's a general partner, which is us, and Anthony and I, as I mentioned before, the general partner. And then the limited partnership owns a nominee corp, which owns the land. And then we hire the developer under a development management agreement. And so we can get into some of the numbers. So you can see that big zero next to HST is a great thing to see that it's no longer in our budgets. So we're able to lower the price and reduce our revenue basically because we don't have that HST number that we're collecting. So really, people say, oh, the developer might be pocketing the HST. We're not pocketing the HST. What's happening here is we're lowering the prices and making the houses more saleable, which was what the point of the HST rebate was. And so you can see the numbers there, gets us to about a $15 million profit. We're putting in 11 million of equity. Purchaser's deposits are about 10.5, construction loan of 58 million. And then some of the metrics I mentioned before, the 660 per square foot, 2.6 year time horizon. And so when you look at that from a sensitivity analysis, we kind of said, okay, let's say you put 100,000 in, what does that look like? Because we have IRR hurdles for investors, they're basically getting most of the money first. So the way this reads, it might not be so intuitive, but our base case is 14.7 million in profit. You're going to see 160,000, a 60% return on your money. But even if we have less profit, even if we're only 8 million in profit, you're still getting to 156,000. So, we could end up not reaching the profitability that we want, but that will impact the developer more than it will impact the investors. And you can see conversely, if we get way more profit, it's a little bit more for the investors, but investors are kind of they have a 20% IRR hurdle that we're trying to get them to, and after that the developer gets more. So can show it to you here on our waterfall. First, investors get 100% of return of capital, and then there's a 12% IRR hurdle. So that's really what you get most of the money out of your hurdle. And then after that, you get 55% of the profit until you reach a 20% IRR. And then after the 20% IRR, the developer is getting the majority and you're getting 30%. So you still get after the 20 IRR, but it's just a smaller number. So what does that look like in cash? So 11 million comes in from investors. If we just make 5 million in profit, investors get everything. Developer gets nothing. So the first 5.2 million goes to investors. And then the next is the second hurdle where there's a split. And then that gets investors to a 20 IRR. And then after the 20 IRR, there's still even a little bit more money for investors. So one of the things that we've been asked to talk about a little more that we haven't always done in the past is to go through some of the risks. And so I'm going to go through what I think are kind of the 5 key things to think about. The pre-sale market is obviously the biggest thing because it's non-existent right now. Well, not non-existent, with 1,000 townhouse sales. The condo market's pre-sales are not happening. But we have the ability to convert to PBR if the sales are soft. So that was what I was talking about before, that we are going to start construction no matter what in 2027. And that's the construction financing. So if we can't get the pre-sales to get the construction financing, we can do it as a purpose-built rental, and we can move ahead, and then we can decide to sell later, or build it as a rental and sell it as a rental building at the end. Zoning and approvals, well, the city staff recommended, and we're up for council decision on Thursday. So once the city staff recommends, the council's just kind of rubber stamping. So we're expecting that on Thursday. And then on the construction costs, well, one of the things that that every project has to deal with is a cost consultant, a quantity surveyor. So every month someone, well, maybe not every month, but every time you have a draw of capital from your bank loan, the developer has to have a third party come in and do it's like a 100-page report on every nut and bolt in the project, every single detail of the construction. We get copies of those reports, and we're able to stay on top of the developer and make sure that they're building towards plan. And we'll be aware of any problems early if they do come up. And then the sales velocity and pricing. So that was a sensitivity analysis that if we end up having to lower our prices, we still see a great protection for investors because of our hurdle rates. And so just to summarize, we're raising 3.5 million to finish the deal. And I think we're already down to 2.8, 2.7 because we've had a whole bunch of orders come in already since we put this out last week. City staff has recommended the zoning approval. It is a limited partnership. So, we do recommend that if you invest through a corporation, it will be active income that you would be getting in your corporation. We are partners with the developer, and we are putting up the money for the development and project, soft cost, site plan, and sales program at this point. Minimum investment is $50,000, but it's not 50,000 increments. It's $1,000 increments. So you can do 51, 52, 58, 112, like whatever number, as long as it's $1,000 increment above 50. 2.6 years is our timeline, with estimated returns of 60.6 and an IRR of 20.8. And so with that, I'm going to open the floor to questions.
Are the RSP and TFSA eligible?
No. So for RSP and TFSAs, it needs to be in a mutual fund trust structure. And to do that, you need 150 investors. And so normally, if it's only 11 million, we don't expect that we'll have that many. No. Someone on the, I just saw a question on the Zoom. I don't know how we get those questions.
Can you hear me or?
Oh, yeah.
Oh, perfect. Hi, Devin Perman here. How are you doing?
Good. How are you?
Good. Two questions. Were the numbers adjusted based on the new DC cuts that they came in? Did you guys implement those DC charges that are not going to be as much?
We made an estimate, but we don't know exactly what they are yet. So we will fine tune it when they actually announce what those reductions are.
Okay, and the HST rebate thing that you mentioned, that's for now, it's applicable until any sales that is until end of March next year. Is it like, are you guys following that timeline, or are you expecting it to be extended?
Well, I think it probably will be extended, but we are following that timeline. We're going to launch sales later this year. And our expectation is if they don't extend the timeline, that January, February, and March of 27 are going to be really hot. Because if you think about it, a buyer is going to save 13% of the price if they buy it on March 31st. And if they buy it on April 1st, they're paying 30% more. So unless the government extends it, we think that Q1 27 will be a great time to be selling, because everyone's going to try to get in before the HST rebate gets removed. But it probably will get extended, because I mean, the federal government hasn't even stamped it yet. The province has made it official, and everyone's waiting for the feds to put it into legislation. So
awesome. And my last question is, I've seen your other project up in Scarborough that is done. So the bedroom size are pretty good. And when you mentioned that the bedroom size, I mean, you're going to have 3 and 4 bedrooms on this project, are they going to be like legit bedroom size properties? Because what we are seeing today in the market is like 2 bedrooms that we cannot even fit a standing person in those bedrooms. So I'm pretty sure that has been actually looked into.
Yeah, so I mean, I think we were referring to, like, we built condos that were 2 bedroom and 650 square feet. And
exactly.
You couldn't really have 2 people live in 650 square feet. What's interesting is if you compare to the Huntingdale project that you mentioned that had good sized bedrooms, those were not stacks. They were full towns, and they weren't 1,400, 1,500 square feet. They were around that 1,200 square feet. So on the 1,200 square feet, you saw good sized bedrooms. These ones are going to be a little bit bigger. Mike, you want to add?
Just for further context, those on Huntingdale, the average width of the unit was 4.1 meters. Here we're 5 to 5.25. So these are more like wide, shallow units. I think our average bedroom size is like 8.5 square meters. So you can easily fit a bed and with a walk around and nightstands.
Yeah.
So
awesome.
Yeah, much more family oriented.
Yes.
Perfect. Thank you.
Great. Anyone else on the call want to ask a question? I didn't realize that you guys could. Yeah.
What's your assumption for DC
Or
DC cuts?
well, I think we're hoping that they
okay.
end up being 50%. I think in the pro forma we didn't quite do 50. I don't know exactly, but maybe like 30, 40%. The thing with the DCs is there's development charges, and we put it into kind of one bucket. But I don't think that the $8.8 billion is going to reduce everything. I don't think they're going to reduce the parkland dedication. I don't know if they're going to reduce education levies. So when we look at DCs, we basically look at all of the government charges. But I think there's only one kind of bucket of them that they're going to be reducing. So we'll see what happens.
Thank you.
Any other questions? Great. I guess covered everything well in the presentation.
You did a good presentation.
Thank you. Okay, well, there's some more food and drinks, and we have the space for a little while, so happy to answer any questions anyone has individually. I will say that we are doing a closing next week, Thursday. So if you are interested, ideally we could talk this week and start working on paperwork, and then get into the closing next week. Oh. Thank you very much.